All right. Hello, guys. This video, as usual, I do not have a script. I do not intend to spend any time editing it, and therefore I may bounce around a little bit. So, my apologies in advance. These videos, I make them specifically for my son and a couple of other people that are learning how to trade, and within my working group. Beyond that, if you find them useful, beyond that group, if you find them useful, fantastic. And if you have any questions or comments, feel free to leave them either in Discord or in the notes below. So, um, my last video, I talked about the sort of, I gave an introduction to how the markets work. And today I want to speak more specifically about how to look at starting to trade the markets. Now, my focus is on the futures markets. That being said, this pretty much applies to anything that trades in the capital markets, so equities or futures. I suppose it could apply also to Bitcoin because I am entirely a technical trader, which means that I am trading based on the visual representation of how price is showing on my screens. And although I do take into context some macro environmental elements, such as is there a potential war? Did an economy in the Western world fail? Has there been an attempt on a president in the United States? So on and so forth. Those do factor into how I trade, but by and large, I would say the majority, 95 to 98% of the decisions that I make are based on the chart. And the reason being that, as I said in the last video, there are only two real-time indicators that are useful, that are accurate, I should say, and that is price and volume. Everything else is either a lagging indicator, it's or a calculation based on price, but the only true indicator, the real-time indicator, is price and volume. Therefore, I typically look to trade elements of the chart that are based on actual printed prices and actual printed volume. So let's get to it. So, I'm just going to imagine that you've never traded before. All right, and I think that I talked in the last video about candlestick, how price is represented visually on a screen. And so we've gone over, you see here on the screens in front of you, you have here on the left a 15-minute chart, and on the right you have a 2-minute chart. Um, Myself and my son and my trading partner Brian, we have a very specific system that we trade, are the lines that you're seeing on the screens in front of you. There is no magic to it. There's nothing on these screens there's nothing here that has not been done before, by and large. So I'm going to go through it with you. But the first things to note is um, I'm going to take away, what I'm going to do is I'm just going to take away all studies. I'm going to make this a naked chart. Remove all studies. Okay, so here we have a naked chart. I'm just going to remove the drawings and remove the alert. All right, so this is a 15-minute chart that is showing price movement in the NQ futures contract. I have the MNQ up, which is the micros, but this is showing it's all the same thing from a price point of view, or from a chart structure point of view. So we have here the entire session from starting starting last night at 6 p.m. Eastern Standard Time. So there we have the start, and it will end at 5 p.m. Eastern Standard Time. So 1800 hours to 1700 hours New York time is the NQ futures market. And as you can see on this 15-minute chart, you can see that we You can see the type of day that it has been. And at one point, the NQ, the NASDAQ, was down a little over 800 points, which is obviously a very large drop. If you see here on the daily chart, you can see here we are. Um, this will give you an idea of the type of move down that we had today. Okay, so the past 3 days have just been down, down, down. Interestingly enough, we have not hit limit down yet, which means that if the price in the NASDAQ futures decreases more than 7% from the prior day settlement price, so in this case, today is being Monday, or it's the Sunday night into Monday session, if we had gone more than 7% from Friday's settlement price, the market would have triggered a limit down scenario, and we can get into that another time. But a limit down scenario has not happened so far, despite the fact that we are down a decent amount since July 11th. So if we look at the total range from July 11th, um, we are 17, so we hit at one point today, we were down 17.34%. It looks like we're going to close from July 11th, we're going to close down about 13.67%. The market is still open for another hour or so, so we'll see what happens. But um, so here we are on the daily chart. And we can see how price has been moving. You know what a candlestick is, and you know a little bit about candlestick structure. So I'm going to go back to the intraday chart, and here we go. So when we trade, or when I trade, I am always looking. My job as a trader is to make money by taking trades that are going to obviously appreciate in value, regardless of whether I am short or long. Okay, so an example of a short trade where there's a high probability of a turn, and you can see this even if you've never traded before. If you are told that your job is to take a position at a lower level and sell it at a higher level, then in looking at this chart, you can see that there are clear patterns taking place, right? Oh, sorry. You can see that there's clear patterns taking place. And your job as a trader is to trade those, correct? So if I were to say, looking at this historical chart, right, because this is already past, where would you go long? Well, my guess is that you would tell me to go long somewhere in there, and I would ask you where to sell. And you would say, well, sell in there. And you would also go short here, okay? And you would probably reverse your position either here or here. This obviously is for illustration purposes only. If trading was this easy, hindsight is always easy, which is why people who trade armchair hindsight traders are always multimillionaires, because they're not actually placing a trade, right? So what you want to do is you need to start looking at charts, right? As a new trader, your job is to look at new charts and start to get a sense of visual representation of shifts in market sentiment. Okay, so this on a 15-minute chart, we are always looking for small bodied candles after a long leg down or a leg down. Okay, not all legs are this long. The volatility in the market today was exceptionally strong. So you get these big downwards movements and these big upwards movements and big down and big up. This is unusual on a 15-minute chart. This is unusual. If you look at the price action here, this would be more typical. a 1,000 point move in a day is not common. So what we're looking for is we are looking for indications in the visual of the chart to show us where, in this case, sellers are starting to become exhausted and buyers are starting to step in. Okay. And you can look at candlestick structure, which in this case would be the printing of a 15-minute doji. Okay, that's one indication for us. You have a long wick, price reclaimed and held, a doji. This would be an A plus setup for us from a candlestick structure point of view. Okay, so we have a small bodied candle here, and at the top, this move, we can see that the buyers are getting exhausted up here, with this small candle, and we would be looking for a reversal here. Now, it's possible that there are some of our levels that we would be looking at here, but for now, I'm going to keep the system off the chart, and because I think that's really important for new traders to learn how to trade price structure and in the form of candlesticks or bar charts, whatever it is that you want to trade. So, for example, would have been in the overnight session, which I did trade last night. You can see here that there was a level of support here, and when it broke through that, also an indication that prices are looking to sell off. You have a situation here where support, okay, this is the opening 15-minute bar, and when price failed that bar, it continued downward. Um, and really what it is your job is to make decisions based on probabilities, okay? Um, because there are no certainties and no two trades are connected. No two trades are meaningful to one another. It's only in the aggregate of many trades that the probabilistic side of trading starts to come into play. So your job is to make an assessment based on the information that you have at your disposal and execute a trade that has as high a probability as possible of working. So for example, if I told you, and this is for illustration purposes only, if I told you that a failure of this kind of support on a 15-minute chart has an 82% success rate, well then I would hope that you would take that trade every single time, because it means that 82% of the time you're going to be profitable in your trade. Um, if I told you that it has a 22% chance of success, I would hope that you would hold off from taking that trade. Okay, so I just mentioned twice. I brought up the concept of probabilities and taking trades that have a high probability of success. And I just want to say, stepping away from the chart for just a moment, the success of a professional trader lies in their ability to think in probabilities. If you can very quickly grasp the notion of probabilistic thinking, then your journey as a trader will be so much further ahead than for someone who is unable to understand that there are no certainties in trading on an individual trade basis, but that there are certainties around the law of large numbers. And what that means is you every when you place a trade, you are making a decision that has X percentage chance of success, and obviously the converse percent chance of failure. And really what it means, so if you have an edge, if you have a systematic approach to trading and you understand, or when you start to understand how to read a chart, you will know, for example, that in this particular situation, taking this trade short here has a, let's say, 76% chance of success. So you know and you accept the fact that when you are placing a trade, there are no guarantees as to whether or not it's going to work out or whether it's going to be a profitable trade. And that is why successful traders, when they place a trade, they accept the risk and they let the trade play out. This is very, very important. The majority of professions are built around the concept of always winning. Losing in the majority of the world, whether it's academic world or the business world or whatever it is, the concept of losing is a negative. Whereas in trading, losing is an integral part of success. You cannot be successful as a trader without losing. There's not a trader on the face of the planet who wins 100% of the time. And it's extremely important because this is going to shape your mindset around trading. If you can't lose on an individual trade or a series of individual trades, then you will not be able to ultimately make it as a trader. You need to be able to come to work every day and place trades with the acceptance that X percentage of them are going to be losers. And when you get to a place where you start thinking in probabilities, meaning every decision that you approach, you are very quickly able to assess the probability of success and failure and then make a decision accordingly. The faster you can get to that place, the faster you will become profitable. Now, of course, you have to have a systematic approach to trading that has an edge to it, right? There has to be a mathematical edge to your trading. You can't just be throwing a dart at your screen hoping to make money. But assuming that you are able to get to a place where you're able to interpret price through structure as it's represented on the screen in front of you, and have a system that provides an edge, meaning that your edge will allow you to make more than you lose, you'll do fine as a trader. Okay, so back to the chart. Regardless of the time frame, what you're looking for is you're looking for changes in structure. So I've shown you a couple of locations here. Let's just get rid of these, remove the drawings. Okay, so I've shown you a couple of changes in structure here. Okay, we've sideways consolidation and a fail below. Sellers overwhelmed the buyers and price failed to the downside. Here, sellers became exhausted and buyers stepped in, as evidenced, as shown by the candlestick structure. Again, here we have a situation where buyers were showing that they were becoming exhausted with the printing of a 15-minute small-bodied candle up here after a very long upward movement, so on and so forth. Okay, so and again we had another little turn here. These are um, these are what you're looking to identify changes in sentiment. And when I say changes in sentiment, what I really mean is you are looking to identify areas where selling volume is decreasing, buying volume is stepping in. And the reverse. You're looking for areas where buying volume is decreasing and selling volume is coming in. So this would be a very good example of a sustained upward movement in price, coming to a place of potential exhaustion and ultimately rolling over. And this is where a trader like myself would go short. Okay, and then when you add a system, now in our case, Just let me throw up our system here, or my chart setup. Okay, so just let it load. Okay, so I'm not going to get into what the lines are right now, but hold on just a second. I need to add. Okay, so for example, this was a very large trade for me today, and I've circled it. I waited for price to come up to a level of overhead supply, meaning that there were a lot of orders, a lot of sell side orders sitting up here, and I knew that there was a high probability that price would, if it made its way up here, that it would likely exhaust and turn around to the downside. And in this particular case, this was less of a candlestick structured trade and more of a trade based on overhead supply levels, which we're not going to get into right now. But just to show you how you have structure, and let's just look at it on a lower time frame chart. So you can see here. Let's get rid of these. Just a minute. Okay, so we got rid of all those arrows, and we're going to take off all the lines. Okay. Oh, sorry, all the drawn lines. Okay, so this is a 2-minute chart, so there's much more noise on this chart than there is on the 15-minute chart. But I just want to give you an idea. You can see here, you can see how price traded, but you can see even in the 2-minute chart, you can see the ebb and flow. Okay, you can see changes in sentiment. You have a change in sentiment, change in sentiment. And by change in sentiment, it's just you have a change in the price action. All right. So the 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 lower the time frame, the more noise that there is going to be, meaning the the individual movements, you have far more candles, so it's going to be a lot busier on the chart. All right. Whereas if you're looking at this is going to if you're looking at a higher time frame chart, as you go up in time frame, it's going to become, especially as a new trader, I think it just becomes a little bit easier to get a sense of what's going on. I mean, that's much easier to read um, than the 2-minute chart. Now, there are benefits to the 2-minute chart, so I'm not telling anyone to discount any particular time frame. I really do believe that time frame um, time frame is very specific to the trader. What kind of trader are you? What is your personality like? What are you most aligned with? I personally, typically, the two time charts that I have up during the day, or the three, I should say, is I have the daily, I have a 2-minute, and I have a 15-minute. And I will sometimes move back and forth between a 5 and a 2. But it's very individualistic. And my chart has pivots on it from higher time frames. And so at any rate, I'm digressing a little bit there. So let's just go back to structure. Okay, so that's really what I wanted to talk about today, is just getting to learn structure, because your job is to identify changes in sentiment. And that may seem easy. On a day like today, it was actually pretty straightforward. On a day like Friday, it's a little bit less obvious, because the price action is much more in a sideways consolidation. So this would be a day where you would trade. It's more of a range bound day. And let's just see, we have what looks like to be a relatively defined range, with this being the top of the range, bottom of the range. And so range traders, myself included, who, when there's a range, I trade the range. So I'm less looking at structure and more looking at the upper and lower, the outer limits of the range. And I will take entries short, and I will at the top of the range, and then I will sell them at a location in the range that I feel makes sense. And I'm always looking to see if there's a base. So, this would be another. You could look and here we go. Just hold on. Okay, so there's a primary range from 11:30 to the through the end of the day, but I would take short and exit cover here and go long. That is a typical trade for me. I do find that the 2-minute chart in range bound price action is easier. It's easier to decipher. So let's just okay. So that is sorry. That is a 2-minute chart in that same range. So I would continuously sell and or short at the top of the range, and then reverse at the bottom of the range. Um, but that's the very basic approach to trading is, I mean, that's a trader's job. A trader's job is to identify changes in sentiment and trade them. And and in doing so, they have a much higher degree of a much higher pr- chance of success if they're thinking in probabilities. If every single time I take a trade, I think it's going to win, I'm going to be in for a world of hurt because what's going to happen is every time I get a loss, I'm going to my mindset is going to become um, I'm going to have a change in my mindset that's going to affect my ability to objectively interpret what is taking place in front of me. And that is why, trading, the best trading is boring. It's somewhat dispassionate. You're disconnected from your individual trades. And it's hard to explain the theory of it, but it's very important that new traders develop the ability to be simply trade their process. Forget about the money, don't attach to the money, and don't attach to the wins and losses. Trade your process, trade your edge, trade your system. And if you do those things, if you think in probabilities and you trade an edge, a system with an edge, the money will come, right? So I think we're just going to leave it at that. It's the first thing is to look at charts, go over and over charts, hundreds of charts, thousands of charts. I can't even. It's been thousands of hours over the years that I have been looking at charts, trading charts. But in the beginnings of my career, I mean, the first the first chart that I would have looked at and traded off of was probably in 1996 or so. So almost 30 years ago. And obviously, the charts of today are very different from when I first started doing technical analysis on a computer. I mean, we're talking about the very, very early days of electronic charting back, which probably started in 1990, 95 or 96. And obviously, it has evolved significantly in terms of the speed and the evaluation tools that are available to us. But the essence of charting is no different today than it was in 1996, right? Price, open, high, low, and close prices represented in either a bar chart or a candlestick chart or a line chart. That has not changed. So what you're seeing here in front of you um, is exactly what I would have seen 30 years ago. And if you can become an expert at trading a naked chart in the same way that Tom Hugard does, and I highly recommend reading his book, Best Loser Wins. He's a great trader because he is able to interpret a naked chart. Now, that doesn't mean that he doesn't put some lines on a chart and identify pivots and areas of support from a prior day and all that kind of stuff. That doesn't mean that he's not doing that. He is. But he's a great example of someone who sees, th- who has identified the power of trading a naked chart. And I think that that's where everyone should start. Um, so I will stop rambling. I'm going to leave it at that. But I will say to you that when you finish watching this video, you should open a free TradingView account, tradingview.com, create an account, either use their free account the, or pay the monthly subscription for whichever level makes sense to you. But it's great trading. It's a great charting platform, and you should just be going over days and years of stock charts or futures charts. And I would recommend that you look at the, I'll put this in the notes, but I would recommend that you review the NQ, the ES, the Russell, and even though I don't really think that there's any need to trade anything else other than perhaps ES and NQ. For sure, NQ. I don't really trade anything other than NQ these days. There's just no need. But you just want to be looking at charts after chart after chart after chart and using the drawing tools on your screen. In TradingView, you want to be identifying those areas where it turned. And the more you do it, the more your eyes are going to become accustomed. For example, beautiful reversal candle right there. Very, very, very nice. Um, and the more you're going to look at charts, and you'll start to find yourself when you get to a place where you're going to start actually learning how to trade, which is not that far down the road. You'll start to Your brain will automatically take you to a place where you are identifying and believing in the probability that this is a reversal setup and taking it. Another super nice setup. Failure of recent lows. I mean, it's very, very clear. Obviously, like I said, hindsight is always 2020. But um, these are the kinds of things that you want to be starting to look at. And by the way, these are called pivots. Okay, so I'll identify some pivots for you just so you can. A pivot is a location where price resisted off of or supported off of. Okay, so this for me would be a pivot. So it's an area of resistance or support. I mean, we don't have to get, um, this would be a pivot. Okay, we don't have to get too complicated about it. But these are all, this would be a pivot. So if price were to fail through these levels, I would pay attention. And, if it were to come back up here, that would be a notable pivot. Same for down here. Okay, I'm going to leave it at that, and I will wish you a great day.